Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm GOVINDRAJ, ETHIRAJ. Well, if you were watching this show last week, you would have known that all the economists who were on our panel had predicted a 25 basis point cut in the repo rate. Well, that has indeed happened. The Reserve Bank of India has cut interest rates by a quarter point or 25 basis points to 6.25%. Now, the Reserve Bank hopes that inflation will be under control and comfortable liquidity conditions will support a revival of credit to productive sectors. The Reserve Bank has also said that India's growth momentum would continue thanks to a normal monsoon raising agricultural growth and rural demand, as well as a stimulus to urban consumption spending from the Pay Commission. Now, the question we are asking is will banks pass on this rate cut to borrowers, and will the lower rate achieve the objectives set out by the Reserve Bank? To discuss this, I am joined by Murthy, Nagarajan, Head of Fixed Income at Quantum, Anish Chakravarty, Lead Economist and Partner at Deloitte, and Suvodeep, Rakshit, Economist at Kotak Securities. Thank you all for joining me. So let me begin with you, Anish. The sense is, while the 25 basis points cut was expected, including by our own panel, there was still some surprise. Why is that?
I think the surprise was twofold. One is, of course, the MPC, the formation of the MPC. Then second was we had a new governor. And I think the surprise was purely it was more accommodative than you would have seen from perhaps
the Monetary Policy Committee, which with 6 members.
That's right.
And that was a fresh
That's
approach.
right.
Yeah.
And again, the views were unanimous, what we heard. So I think that was it, really, more accommodative than what we would have expected, because I still believe one-off inflation number, which may be very good, because if you go back 1 month, the numbers were much higher. So I think it's really the trajectory and all that which was perhaps surprising, but again, largely expected.
So, Murthy, is that something you concur with? I mean, there was some economists seem to feel that we could have waited for another 2 months so that food inflation would play out, because it could surprise on the upside.
What the point is that how he has given this rate cut is more important. We were thinking that, okay, when we were thinking there will be 25 basis of rate cut, we thought that March trajectory of inflation will be 5%. Now, as per their charts, they are saying that the March trajectory of inflation will be 5.3. If the inflation is 5.3, why did you cut rates from 6.5 to 6.25? Now, the question is that what they have done is that they have tinkered with the real rate. So, whatever is the rate which is over and above the CPI inflation, which was 1.5 to 2%, the real rate of interest.
That's policy rate minus inflation.
Yeah. So that they have bought it to 1.25. So now the feeling is that if you are done to 1.25, why you cannot bring it to 1%?
Okay.
So the point is that that will again give them space for cut one more to 25 basis point of rate cut. So now the policy has changed. Now the fear is that whether to overdo the growth, actually we don't have any. People start cutting indiscriminately, and we go back to 2013 when we had current account deficit of 4.5% and all these things because we were not following a proper policy. That's a fear, because the fear was that the feeling was that if Rajan was there, this rate cut could not have happened. It's because Urjit Patel is there, we are seeing this rate cut. Now the question is that whether the independence of RBI is compromised. So these are the questions which everybody seems to be asking right now.
Okay, for which they may or may not be answers. Suvodeep, what's your sense and reaction to the interest rate cut?
I think beyond the 25 bips cut, I think it's more important to recognize what market or the economist were looking at is some kind of continuity with the policy that we have been seeing for the last, say, 2 to 3 years. If we were in a regime where we were looking at, inflation being a concern and the reaction of the RBI being to containing inflation, say, at first of all 5% and then 4%, this policy was in some sense a deviation from what we have been seeing in the earlier policies, or what kind of noises had been coming out of the RBI. When I say, it's a deviation, specifically I mean that, if we were looking for, say, whether a 4% in March 2018 is achieved, we were unclear after the, the conferences and etc., whether that 4% is still being targeted, or whether we are now looking at a 2 to 6% band. My sense is that we are now moving towards a 2 to 6% band, and within which the RBI will be pretty comfortable in terms of where the inflation is headed. Further, also, we were looking at a 150 to 200 bips real rate as one of the guiding factors to understand where the rate cycle might be, which also seems to be now a deviation from what we were expecting. So in that sense, I think we are kind of, entering a new regime. If I were to kind of deliberate a little more and kind of talk about what the spirit of inflation targeting actually is, it's not reacting to what your past or the immediate past inflation has been, but what your, the inflation outlook is and what your reaction to that is, more from a 12 to 18 months horizon.
Right, Anish?
So I just wanted to say, one of the things which is important, Govind, is to dissect the numbers. And if you dissect and look at this particular month, there are some very important observations. One is vegetable, where the index itself was at 14, it's fallen to 1. If you look at food, which was roughly at about 8, has fallen to about 5.83, so roughly about 6. But the one which I really focus on is core inflation. And core at 4.5 for now. And if we go back, core between 4 to 5 is holding steady. So I think that gives a sense of comfort that core itself has a steady base.
Okay.
One of the other things which is, we've had a high base effect. So base effect was expected to play, which means going forward, one of the expectations is that food numbers are going to remain low. The governor has also made a statement that if you look at the monsoons and the sowing and the patterns of so on and so forth has been very good. So I think the expectation is food will remain low. Core has remained stable, and that's perhaps one of the reasons.
Right. So let's look at it from the other point of view, so this was supposed to be a growth move, right? So to what extent is this delivering that, and to what extent is it not delivering, or more needs to be done?
One of the things is inflation has always been linked to growth. We've seen with other governors in the past as well. But to me, the monetary policy is purely on account of two things. One is inflation and liquidity. It is really not growth focused as a primary objective. Having said that, we are again seeing comments from the governor and from the MPC on growth at the GVA of 7.6%. Our expectation is around 7.3, 7.4%. I think one of the single-handed important thing which we spoke about earlier is the transmission mechanism itself. So 25 basis points is great, but if the transmission really does not happen because of NPAs and small saving cycle and so on and so forth, then you're really not going to have that transmit down to the economy. So I think that's where some area of work is required rather than this cut.
Right. Okay. So Murthy, what's your sense? Is this going to be the growth trigger? Assuming that we know all of this, but we are taking a growth bet, which clearly this seems to do.
The growth bet is already paid off. That monsoon has been good.
Okay.
So that way you will see that. Okay.
No, industry has been asking for a lower rate for a while now. So
industry has been asking for a lower rate, but after all this rate cuts which has happened, it has not. Actually, the problem with industry is that the debt is very high. Like if you look at the IMF report which has come out yesterday, after Brazil, we are the most indebted country. So our repayment capacity is the lowest after Brazil. So your whatever is the profit before tax, it's not able to cover your interest also. So given that situation, even if you are going to cut rates, how is it going to? It's actually the demand stimulus which has to come for the government to spend. So already we have seen this happening. In the first quarter, we have seen that your GDP number has come at 7.1 GVA number. But if you strip out government, it is 5.7. So the government has given you the stimulus, but now the fiscal deficit is now at 78%. April to August, we are already at 78. Your revenue deficit is at 92%. So now the government, and now your spectrum auction, you are seeing 30,000 crores of shortfall. So it is going to be a very difficult task. I don't think rate cuts are actually the thing. It's only people are trying to say a lot of things, but it's a global growth. Actually, if you look at our market, manufacturing sector, 40 to 50%, either it is getting affected because of global growth.
Okay.
Yeah,
right. So, okay. So, Anish, let me come back to you. So, if you were to say that growth will be in some ways, constrained by, let's say, so many external factors, including the state of the global economy, which has been pointed out by other people as well. So, what else could we be waiting for then?
I think, pointing onto the RBI and saying that they have to do something about growth, I think is the wrong way to go about, right? Yes, the global economy is sluggish. India has performed at 7. If you remember a few months back, there was this huge comparison between India and China, which I think is wrong. If you have to look at our fundamentals, agriculture will deliver because of the sowing pattern, because of the numbers, as Murli rightly said. Industry will be a worry. The debt is high, but there is more expectation of credit. And that will come if the SI cycle, the savings investment cycle goes
What
up.
if there was a fear that this 7.6% would not have happened?
If it wouldn't have happened...
Or will not happen, yeah.
Well, I think the problem is if 7.6% doesn't happen, will it fall back onto the RBI to deliver that? And to me, the answer is no.
Okay.
That is not the way to go.
What's your sense?
In the sense,
no, will 7.6% happen, or is there a fear that, things may not go the way we thought?
Yeah, it can happen because now what has happened is the 7th Pay Commission will give out grants of around 1 lakh. So that amount will be spent. And now what they are saying is that if you look at RBI report also, from 84% of capitalization, we have come down to 70. Now they are saying that input prices and all are going up. So there seems to be some amount of demand. In a country like India, if you don't have growth for 2-3 years, there's a natural rate of growth. So we did not have growth for the last 2-3 years. So whether it's car sale or if you look at Maruti numbers, they are saying that we cannot produce more. The demand is high, but the production is less. So definitely with this 7th pay commission, you will see kick-off happening as far as growth is concerned. So I don't think it is the RBI's job to, anyway the growth will automatically happen because of this payout which has happened.
Right. So since you mentioned Maruti, I mean the chairman RC Bhargav said that rates are important, but there are other factors like petrol prices. He also says that when banks will pass on the benefits to buyers, it will be a relief, but he doesn't expect too much impact on sales.
Yeah, but he in the same interview has said that his production is running at full capacity.
Of course.
He does not have any problem.
But industry will always want more than.
Yeah.
Yeah. Okay. So we're running out of time. So Suvodeep, can I get a quick close off from you now? What's the sense going forward? I mean, are we looking or expecting another cut in the next couple of months, or are we okay for now?
I think my sense would be let's look at a say end FY17 kind of a time frame, and possibly December. I think they have kind of front loaded the rate cut, so I would be more on a February where more or less you have a sense of where the inflation is heading, where the global volatility etc. How they are panning out, what the Fed is doing etc. and also some fair bit of sense possibly might emerge in terms of the budget numbers also. It obviously depends when the government announces the budget. So my bet would be more on the February rather than a December for now, because I think the December one has been front loaded and they might want to just wait out and look at how their rate cut pans out and how the inflation trajectory also pans out from here on.
Right. Murthy?
Oh, my feeling
Looking
is
ahead, yeah, next 3 months.
Next 3 months, not a cut, but later on he will give another 25 basis point of rate cut. The expectation is that again he can always tinker. Now we have already seen how he is going to give the rate cut. He will reduce the interest rate from 1.5 to 2. He has made it to 1.25. He'll bring it to 1. Now our fear is that he should not go below 1. Like he should not say that the real interest rates can go below 1 also, because globally rates are negative, the real interest rates are negative. So he should not do that, because we already had a problem in 2013. So if he does not do that, another 25 basis point rate cut is possible, and which will be good for the market.
Okay. What about you?
I think it's a loaded question, Govind. There are three things. One is the inflation anchoring itself has changed. The 5% of 17 and 4%. Now it's a plus minus 2% in a midterm to 2021.
Yeah.
So he's giving some leeway to himself. So that's one. The second thing is he's mentioned about upside risks. So one is of course the HRA impact coming in that we are seeing, and the second is again the whole economy and the demand generation out of that. So my sense is Q4, if the numbers hold, if it doesn't hold, not going to happen.
Right, we've run out of time. Thank you all for joining me. We need to go in for a break. Coming up on the other side, we find out what industry has to say about this rate cut and what they feel needs to be done further. Stay with us.
Hello and welcome. I'm Amritanshu Rai. You're watching Constitutionally Yours.
इस तरह का वातावरण बनाना पड़ेगा कि महिलाएं भी स्वयं आगे आए।
एमपी एमएलए की चिंता है कि शिक्षा डेमोक्रेसी में धीरे धीरे आए या तेजी से आए।
क्यों नहीं हिंदुस्तान में कॉमन सिविल कोड लागू की जाए?
ये नहीं हो सकता कि सारी के सारी पॉपुलेशन एक सरीकी एक कल्चर में ढल जाए।
Join us as we try to understand contemporary issues related to the Constitution. Watch Constitutionally Yours on Rajya Sabha Television.
From cowries to metal pieces, Indian currency has seen many changes. The earliest punch-marked coins came from Gandhar. The East India Company at the turn of the 19th century also minted its own coins. The Indo-Greek coins come from a colony left behind by Alexander. They depict the golden rule of the Guptas, with embossed human portraits and matrimonial alliances like Chandragupta Maurya's wedding with Seleucus I Nicetas' daughter.
Welcome back to Policy Watch. Industry has largely welcomed the Reserve Bank of India's move to cut interest rates by 25 basis points or a quarter point to 6.25%. Now, the feeling is that the move is growth oriented and comes at the right time. particularly given that this is the busy season and demand for bank credit is expected to go up. Now, the question we are asking is, will this be the move that will spur industry, or will it look for further cuts? And are there accompanying policy triggers industry is looking for? To discuss this, I'm joined by Deepak Premnarayan, President of the Indian Merchants Chamber, and Manoj Paliwal, Chief Financial Officer of Omkar Realtors, a Mumbai-headquartered real estate company. Thank you both for joining me. Mr. Premnarayan, let me begin with you. What's your sense? I mean, there seems to be generally a warm welcome for the interest rate reduction. Were you expecting more? Should something else have been done?
No, I'm happy with the interest rate in the sense the cut. One can always say it should have been a little more, but there are other things in the ecosystem that are happening. And the main thing is that even with the earlier cut, the banks, the cuts were not being passed through. So that was one. The reasons for that were manifold. Even with this cut, I'm not sure how much will be passed through. Effectively, the main issue with business today is cost of money. And there are other instruments through which this is happening. This is happening through, let's say, masala bonds recently. It's happening through corporate bonds. But I think we need to take more aggressive steps. We need to take steps in terms of, let's say, capital account convertibility. Bottom line is we need to get inexpensive money which is sticky. And at today's interest rates, even if the cut was, let's say, 0.5%, what would happen is that we would not be competitive globally. For me to be competitive globally, let's say IMC, we have almost a reach of 2.5 lakh members, 85% are SME, MSMEs, and the biggest bone of contention is the cost of money. Now, if they are borrowing anything from, let's say, 12 to 20%, they can't be competitive. GST, for that matter, is a great thing that's happening. If it happens at 18%, effectively it will give us a benefit of about 10%, because currently it's 25 to 30% is the rate. So let's say the average is about 27.5, 28%. It will make us more competitive globally because cost of money.
Right.
So
anyway, so you're saying that competitiveness is a key point, and this move does not completely address that challenge, even if it.
But at the same time, if I might add,
Yeah.
that the GST reform that is happening globally, that's being looked upon very positively. So what's going to happen is that more sticky money will come, inexpensive money will come, but there are other platforms through which we need to work very aggressively to get inexpensive money.
Right, and we'll talk about that and what can be done from a policy point of view. So Manoj, tell us about how it looks from a real estate sector point of view. First of all, how is the sector doing broadly at this point of time? What kind of demand patterns are you seeing, or supply patterns that you're seeing, maybe in a large city like Mumbai? And then how does this interest rate cut help to the extent that it does?
In Mumbai, if the ticket size is correct as compared to the customer demand, then there is no problem for the demand. And second,
even at this point of time, things have been steady on that front.
We have experience in our few projects, like we launched a project namely Meridia near BKC, and another project namely Ananta at Goregaon. There is very good demand for both of the projects.
Okay. Yeah. So you're saying the interest rate or rate is not an issue there?
No, I'll not say that. Interest rates, due to higher interest rates, the affordability get reduced. Rates like 9.5 or 10% are very high as compared to the income we have in this country. So the ideal rate for a home loan buyer should be around 7 or 7.5%.
Okay. That rate we saw almost a decade ago.
That will give them quantum jump in the eligibility of the people. Like if a person can't afford something today, after the cut in the rates, he'll be in a position to afford the same thing. There'll be benefit of 20-30% at least.
Right. So what about the transmission that Mr. Premnarayan also talked about?
Transmission from?
As in terms of, every time the Reserve Bank cuts rates, how much do banks actually pass on?
Usually we don't see much of the pass on, but you can see liquidity improves. Now more banks are changing, even the developers, and of course home loan market is very, very competitive. Almost everybody who wish to buy a house is getting the home loan. Service quality is very good. That way supply is better, far better. Supply.
So how would you define the market then? Is it stable and looking strong? Is it growing very fast? From your perspective.
Yeah, from our perspective, I'll say the market is stable and going bit strong.
Okay. Yeah. And you're saying an interest rate cut would obviously help you go along.
It will definitely help us. Yes.
Right. Okay. We'll come to what else could help the real estate sector in general and in specific. So let me come back to you. You talked about the other enabling factors that we need to get things going. So GST being one of them. What else is, let's say, the concern of the many members that you talked about?
If I might also go on that, but if I might use his shoulder.
Sure.
The point that was made is that there's been a shrinkage of almost 9.5+% over the last 2 years for loans that have been given out to MSME sector. It's the corporate sector, which is the large houses, it's the shrinkage is 2%. But so what does that reflect? So therefore there is a shrinkage in terms of credit. And why is that happening? There are high NPAs with banks. Now because of high NPAs with banks have also become very conservative. Conservative, so therefore instead the liquidity, I'm not sure, I don't agree with him, the liquidity is not very much there. That's being held back and that's being put into more comfortable pockets like the bonds, etc., government bonds. So liquidity is getting hurt. My businesses are getting hurt when I say I'm talking of IMC per se. So that there is, so this particular cut, firstly it's a good step. It's different from what the previous regime thought of. And I think that the current governor and his team are more focused on getting growth for the economy. I feel that there are various other platforms. Now you take, if I might come back to GST itself, GST is not going to bring in monies overnight. It's going to have a very turmoil period for about 18 months from 1st April. But once it settles down, it's going to bring in a lot of liquidity, white liquidity. The black money is going to get shrunk substantially. So as a result of that, that will also have an impact on cost of money. Because the biggest issue is for industry today, I'll give you a point in case. Today, let's say I'm competing against Japan, or let's say UK for that matter. Money there is LIBOR plus 100 basis points. And this is what Manish said. Whereas over here, if I'm a manufacturer and I'm competing against somebody there, I'm already out of pocket by 15%. You look at my infrastructure projects today, if interest cost is 13%, 20 years is 260%, is just interest payment. And if my margins are about 13%, 14%, my project can never be viable. So capital account convertibility, one.
But capital account is a slightly, is a stretched target, isn't it?
But you start working on that.
Okay.
You take for instance the scheme that SIDBI had launched, I think in 2001. It's got to do with the Credit Guarantee Trust. What does that do? That basically acts as the backbone of ensuring medium sector loans that are given by banks. So it ensures. Right. But what that does is the banks therefore are getting, their risk premium is being cut off. The cost of money can effectively come down. So there are mechanisms. Now, as he said, that with what's also happening in the real estate sector, you're getting sticky money coming in. You take REITs for that matter. There are almost, we were with Mr. Sinha the other day, UK Sinha. There have been very positive changes that SEBI has done. As a result of that, there is sticky money starting to come. In the last 75 days, almost $3 billion has come. And with the further changes that SEBI has done 10 days ago, in terms of the sponsors being increased from 3 to 5, also the 10% going to 20% on developed assets, there's going to be, I believe, in the next 3 years, in just REITs alone, you should get in about $30 billion.
Right. So there's a lot of capital coming in. So does that, let's look at both the supply and demand side. So on capital, when it comes to you as a developer, are you facing any constraints?
No, there is no constraint of capital, but the cost of capital is a concern.
Okay.
Right now, in our setup, in Indian setup, lending to real estate is generally not encouraged. Banks are not encouraged to lend, and their classification, this is loan against land, all that is not allowed. So many times the cost is high. We end up getting money from like NBFCs or from private equity that cost us a lot.
Right. Now, if you were to look at a project today, and so let's say someone who, like you, who bought land maybe 8-9 years ago and were developing it today, I'm sure your cost of acquisition was very low. But let's say if you're acquiring land today and using all these sources of capital and going back to, let's say, customers to obviously pay at current interest rates, how does that whole equation work out?
It's quite costly that way.
Okay.
If you go in that manner, suppose a person is having his own land and he has not incurred any cash for that, or it's inherited land, then it's very effective. Construction loan.
But you as a company have not inherited land.
As a company, then it's costly,
Right.
For land.
No, but is it costly or is it prohibitive? Because if you're able to sell, obviously.
I'll say it's not prohibitive but costly.
Okay.
Still, market is good and we get the rate.
Right. So market is good, but I have to clarify that you're playing at a premium end of the market. So would things be the same at the, let's say, the middle segment or the affordable segment?
I'm talking about middle segment of Bombay. Then it's applicable. Yeah.
Okay. Okay. So let me come back to you. So you talked about small and medium enterprises and that being a concern area. So cost of capital is one. What else needs to be done to ensure that there is more growth trigger or there are more growth triggers for this sector?
As I said, that's the biggest issue. And here,
do you feel enough attention is being paid to them?
No, there is of course enough attention, and there is a lot of effort. You see, like the Make in India program, it may seem like an event, but what's happening is today states are becoming competitive. I mean, to the extent, I'm not exaggerating, Govind, that today, as of today, there is in a particular country in Southeast Asia, a government representation that's gone from here. There's another one going from a neighboring state in the next 2 weeks, addressing the same company there, a large company to manufacture four-wheelers. Now, the issue in my mind is that they're all competing against subsidies that are to be given, you know, to attract capital. Now, that's another issue. But people are willing to come in here. Just Manish's point, where I feel that...
We're running out of time. Yeah, go ahead.
Yeah. What's important is that we need to get inexpensive monies. The platforms are there. We need to tap it. And I believe that the Reserve Bank has started. A point in case being, NPAs drive down the values of banks, etc. They've started the good bank and the bad bank route now. They've started thinking about that very aggressively. What that will do is that it'll again diminish the cost of money. Because once you take away the bad assets and the good assets are there, banks' valuations improve, and they have the ability then to lend and borrow.
Right. Okay. Last question, Manoj. Are you expecting another cut this year?
Of course.
This calendar?
One more cut, yeah.
One more cut. Okay. Is that 25 basis points or?
25 basis point only, yes.
Okay. Great. So we've run out of time. Thank you both for joining me. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.